December 2, 2001, the day Enron's stock plummeted below $1, a shocking tumble for a company that had once been the darling of Wall Street, valued at over $70 billion just 5 years earlier. It was the moment the world realized that the energy empire built on promises of limitless profit was a house of cards, and the collapse would become the most notorious accounting fraud in corporate history, sending top executives to prison and reshaping the very rules that govern American business. Founded in 1985 through the merger of Houston Natural Gas and Inter North, Enron began as a modest utility provider, but under the relentless vision of its charismatic founder, Kenneth Lay, and the ruthless genius of chief architect Jeffrey Skilling, it transformed into a behemoth that rewrote the rules of energy trading. By the mid-1990s, Enron was no longer just delivering electricity. It was inventing a new market, selling futures contracts, trading weather derivatives, and packaging complex financial instruments that turned power into a commodity that could be bought and sold like stocks. The company's dazzling growth was reflected in its aggressive branding, with slogans like "Ask Why," and a corporate culture that celebrated risk-taking, embodied in the infamous rank and yank performance reviews that pushed employees to outdo the competition at any cost. The rise seemed unstoppable. Enron's revenue skyrocketed from $3 billion in 1993 to $101 billion by 2000, and its stock price surged from under $1 to a peak of $90 per share. The media hailed it as a visionary. Harvard Business School case studies praised its innovative approach, while analysts on the floor of the New York Stock Exchange cheered every new deal. Yet beneath the glittering facade, warning signs began to flicker. The company's earnings reports were riddled with opaque jargon, and the use of special-purpose entities, SPE, to hide debt grew more elaborate with each quarterly filing. Enron's CFO, Andrew Fastow, created a web of off-balance sheet partnerships, LJM, Chuco, and others, that allowed the firm to record profit while shuffling losses out of the public eye. Auditors from Arthur Andersen, once revered for their rigorous standards, turned a blind eye, accepting the company's explanations and signing off on clean opinions despite glaring irregularities. Whispers turned to alarm as skeptical analysts started digging. In early 2001, a handful of investors, notably hedge fund manager Jim Chanos, began questioning Enron's cash flow, noting that the company's reported earnings were growing faster than its actual cash generation. The Securities and Exchange Commission issued a series of no-action letters that effectively gave Enron leeway to continue its accounting tricks, but the market's confidence remained fragile. Internal dissent also rose. A small group of engineers and traders, uncomfortable with the aggressive accounting, raised concerns about the sustainability of the business model. Yet, the company's leadership dismissed the doubts, reinforcing a narrative of unstoppable innovation and insisting that the complexity of their deals was simply advanced finance. The house of cards finally collapsed when Enron's own internal whistleblower, Sharon Watkins, sent a confidential memo to Kenneth Lay in August 2001, warning that the company could implode in a wave of accounting scandals. By October, Enron's stock began its relentless descent as analysts grew increasingly skeptical and credit rating agencies downgraded the firm. On October 15, Enron announced a massive $618 million loss for the third quarter, a staggering reversal from its previously reported $1.7 billion profit. The next day, the company disclosed that it had to restate earnings for the past 5 years, erasing $1.2 billion in profits and exposing the depth of the fraud. Within weeks, investors abandoned the stock, the price plummeting to under $2, and the company's creditors demanded repayment. On December 2, the board declared bankruptcy, the largest corporate bankruptcy in U.S. history at that time. Thousands of employees watched their retirement savings vanish overnight. As Enron's 401(k) plans were heavily invested in company stock, the fallout was immediate and devastating. Arthur Andersen, the auditing firm that had signed off on Enron's financial statements, was indicted for obstruction of justice and ultimately dissolved, leaving a void in the accounting world. Federal prosecutors swooped in, charging Lay, Skilling, Fasto, and dozens of other executives with securities fraud, conspiracy, and insider trading. By 2006, Lay died before sentencing. Skilling served 12 years in prison, and Fasto was released after a 10-year term, but the scars on the financial system lingered. The Enron scandal forced a seismic shift in corporate governance. In response to the public outrage, Congress passed the Sarbanes-Oxley Act of 2002, imposing stricter regulations on financial reporting, mandating internal controls, and holding CEOs personally accountable for the accuracy of their company's statements. Auditing firms were required to separate consulting services from audit work, and the Public Company Accounting Oversight Board (PCAOB) was created to oversee auditors' performance. The scandal also spurred a cultural reevaluation of corporate ethics, highlighting the perils of a win at all costs mentality and the dangers of unchecked executive power. Today, the Enron name serves as a cautionary tale, a stark reminder that innovation without integrity can lead to ruin. The ruins of its former headquarters in Houston now house a mixed-use development, but the legacy of the scandal remains embedded in every balance sheet, every audit, and every boardroom discussion about transparency. The story of Enron is not just about a company that fell from grace. It is a testament to how the pursuit of profit, when divorced from accountability, can unravel an entire industry and shake the confidence of an entire nation. Subscribe to The Collapse for more stories like this.